So we're going to talk about shopping for a mortgage and what different types of mortgages there are out there. So when you're looking for a lender, it depends on what you're going to be doing with the home. So I have some different examples for you. If you're going to be fixing and flipping the house, what you're going to be looking for is a hard money lender. This type of lender is going to be looking solely at the transaction, solely at the deal and the price you're getting it at to make sure you're getting a good deal. And they're going to be analyzing that with, the rehab costs that you provide them to kind of come up with the loan to value ratio and how that's going to fit your project. So hard money, usually interest rates will range between 8 to 12%. Those are going to be interest only payments, and there's also going to be points involved with the hard money lender, usually 1 to 3 points depending on your experience. For the most experienced people, the best rates out there are basically 8% and 1 point. When you become experienced, that they consider that doing 5 flips or more in the last 24 months. That makes you a pro borrower or whatever the lender is calling it. So that is what hard money looks like. A lot of hard money lenders will also offer rental programs. So if you find a hard money lender that offers rental programs, it's great if you're buying rentals that need work, because you can start at a hard money loan. They will lend you the rehab costs, and then once that house is completed and rented out, you can transfer that to a rental loan. A lot of times they do offer a 30-year fixed interest only type loan. If you need a connection for a hard money lender, reach out to us. We can put a link in this video for the lender that we use. So now moving to rentals. If you wanted to buy rentals, the most common lender out there for rentals now is called a Dscr Lender. That stands for debt service coverage ratio. So they are looking at the rental amount, how much the house is going to rent for, and how much the mortgage is going to cost for that house. And the ratio they come up with is the ratio between those two numbers. They have to make sure that the rental amount that you're bringing in is enough to cover the mortgage amount. So that's what debt service stands for, is basically how much the debt is costing you, how much is your mortgage payment with taxes and insurance. And they have to make sure that the rental income is going to cover that. And there's a certain ratio. They usually want it to cover, 1.1 or something like that. They want it to cover more than the mortgage. So rentals, DSCR, these guys are going to be requiring 20% down. Up to hard money, a lot of times you can get 90% leverage, which equals 10% down. That's the highest leverage that you can get. There are some lenders out there that do 100% financing, but the rates and points are going to be a lot higher. I usually stick to the 90% leverage on hard money. It keeps a good balance between the points and the interest rates that they charge. So again, DSCR, they're most likely going to be charging or requiring a 20% or more down payment. But the good thing with DSCR loans is that there's no limit on how many loans you can get. If you move into like a conventional style lender and it's reported to your personal credit, usually there's a max between 5 and 10 homes that you can buy. With a DSCR lender, there is no limit. You can buy 100 properties if you wanted to with a DSCR lender, because they're just making sure that the rent is covering that debt service, and that's all they care about. So when you're going to buy a home for yourself, you're looking at a conventional lender or mortgage broker. So most of the time, this is going to be a 30-year fixed loan. There are 15-year fixed as well. Most conventional lenders, if you want to get the best rates, are going to be requiring 20% down again. But there are things like FHA and other programs, even if you want to do conventional, that are between 5 and 10% down. FHA is 3.5% down. And now in California, there's the CalHAF program, which they are offering to basically down payment assistance provided by the state of California. So a mortgage broker is going to shop around to different big lenders, and they are going to basically make a little spread. They're a broker, so they're going to shop around for the best rate for you. That's their job, is to find the best rate and the best bank to work with, and they're going to make a little spread. So that's what a mortgage broker is. If you want to go directly to a direct lender, a lot of times you're going to get better rates that way, but you're only working with one lender. When with the mortgage broker, they're going to have a lot more options and flexibility with the lender that you're working with. So a lot of times this is going to range between 20 to 3.5% down. Sometimes, again, there is the down payment assistance, which will wipe out your down payment completely. Now, if you already own a home or a rental, you can do a cash out refinance, which is a fancy term. Cash out refinance or a Heloc. So a Heloc stands for Home Equity Line of Credit. These are really, really popular now with owning any home, really. Because the equity has gone up so much, the values of homes have gone up so much. When people were putting 20% down, they had 80% loan to value on that property. But if that property goes up in value 20 or 30%, you can still go back to the bank and get 80%. So say the property went up from 600,000 to 800,000. Yeah, 80% of 600,000, when you purchased that home, the loan was for 480,000. But now if that value of that house went up to 800,000, that lender is still going to allow you to pull 80% of that value out, which is now a $640,000 loan. So when you refinance, the new loan is going to pay off the old balance, and then you're able to keep the difference in your pocket. That's the cash out portion of this loan. So the cash out portion of this loan would be $160,000. That's basically a cash out refinance scenario right there. Just because values of homes have gone up so much, a $600,000 house a couple years ago is most likely $800,000 house now. And you can use that equity and pull out the $160,000. So the difference between a cash out refinance and a Heloc, basically you're refinancing, you have a whole new loan balance of $640,000. You're paying every month on that balance, on that amount, on that loan amount. So a Heloc, the only difference between that and a Heloc is they're going to give you the same $160,000, but it's not doing a whole new loan where your new loan balance is $640,000. They put a separate loan on the property. This would be one loan. This is actually, a Heloc is actually putting a second on the property. And a Heloc is kind of treated like a credit card. So they're going to give you basically a credit card with a $160,000 limit on it. And you can use this like a bank account, and say you want to fix up your property and put $60,000 of a rehab into it. You can pull out the $60K, do your rehab, and now you're only paying interest on what is pulled. So that's the beauty of a Heloc, is that you're not charged interest on this if you're not using it. So if you start to use it, you're only paying interest on what you're actually borrowing from that Heloc. So if you use the whole thing, of course, you're going to be paying interest on the whole thing, but the Heloc is like a bank account, and you're only charged when you use it. So this is an example of all the different type of loans. There's probably many more that I'm not talking about, but these are the basics that are most widely available out there. So if you find this useful, let us know and subscribe to our channel. And if you have any questions, put them in the comments.